This video is about the replenishment of trading stock. So some businesses have a policy of maintaining constant levels of trading stock. This means that the goods are replaced or replenished as soon as they are sold. So, for example, business operates with a fixed markup of 100% on cost. If sales during a particular month amounts to 80,000 Rand, then the cost of sales would have been 40,000 Rand. So if we take the 40,000 and double it, we will get to 80,000. That's why it's 100% markup. The business would therefore need to spend 40,000 to replace the stock that was sold. So then it will be back to the same level of stock. For the purpose of this calculation, it can be assumed that the purchase price of the goods remains constant. Replenishment of trading stock often forms an important part of drawing up a cash budget. If trading stock is replenished, then expected sales amounts are used to determine the estimated purchase of stock and the payments to creditors. So let's illustrate this by way of an example. So the information that's given to us is the actual and budgeted sales figures for January, February, March and April. So actual sales during January 90,000, February 60,000. Budgeted sales March 75,000, April 69,000. The business maintains constant levels of trading stock. The business operates with a fixed markup of 50% on cost. So whenever you read in a question, maintains constant levels of trading stock, it means in fact that we need to consider the replenishment of trading stock. It's like synonyms. The business operates with a fixed markup of 50% on cost. 70% of all purchases of trading stock are on credit. Creditors are paid in the month following the purchase in order to receive a 5% discount required. Use information given below to determine the expected cash purchases for March and April 2017, as well as the expected payments to creditors for March and April 2017. Remember that when constant levels of stock are maintained, then for any given month, the total purchases is equal to the cost of sales. The simplest approach to this type of question is to construct a table setting out the total purchases, cash purchases, and credit purchases for the relevant months. So we know we deal with January, February, March, April. So the total purchases we know is the cost price of what we sold during the previous month, or during that month actually, because we are replacing the stock. And originally we would purchase the stock that we sell at cost price. So that's why we need to calculate the cost price. So in this case, since we have a 50% markup, whatever our sales is, we have to multiply by 100 and divide by 100 plus markup, which in this case is 100 plus 50, which is 150, because obviously cost price is lower than the selling price, so we have to divide by the bigger number to decrease prices. So if we take January's 90,000, it was the actual sales. So we need to calculate therefore the cost, divide the 90,000 by 150, multiply by 100, and we get the cost of sales, which is equal to our total purchases of 60,000. Similarly, for February, we have 60,000 times 100 divided by 150, it gives us 40,000. For March, we have the 75,000 divided by 150 times 100. And that results in 50,000. And then in April, we have the 69,000 divided by 150 times 100,000 for 46,000. That's total purchases. Next, we are interested in the cash purchases, which is 30% of the total purchases. So 30% of 60,000 is 18,000. 30% of 40,000 is 12,000. 30% of 50,000 is 15,000. And 30% of 4,600 is 13,800. So now we still need the credit purchases, which is 70% of the total purchases. So 70% of the 60,000 is 42,000, or putting it another way, 16,000 minus 18,000 result in 42,000. 40,000 minus 12,000 result in 28,000. 50,000 minus 15,000 gives 35,000, and 46,000 minus 13,800 will result in 32,200. By using now this information from the table above, the following solution may be determined. We know creditors are paid in the month following the purchase with a discount of 5%, but let's first focus on the cash purchases. So for March, it's 15,000, and for April, it is the 13,800. Next, we can focus on payments to creditors. So we know creditors are paid in the month following the purchases. So we have to look at February's purchases, because that is what we will pay in March. So the 28,000 Rand times 95%, since we obtain a 5% discount, will result in the 26,600. Similarly, to get April's credit purchases, we will have to take March's credit purchases and multiply by 95%. So it's the 35,000 times 95%, which results in 33,250 Rand.